Jeff Demaso is here to talk about how Greece is weighing on the markets and the other economic news of the day. Jeff is the Director of Research at Arise Investments. Jeff, welcome back to Arise Xchange. As always, let's start with
Andrew.
Greece. They say take it or leave it. Will one side, do you think, blink this weekend? Yeah,
you know, it's really hard to peg what it's going to be. Greece has really been the headline that keeps giving. Just every weekend, every meeting is kind of the meeting, the deadline. You know, my guess would be that they kind of agree to some bailout, some type of kick the can maneuver here. And keep Greece in the euro and in the union. But, you know, that's just one way it might play out. And even then, there's a number of different, it doesn't mean A happens and B happens, which we can get into.
Are the U.S. markets really that susceptible to this? Because when you read the commentary, it's the markets went up on Greece hopes. The markets went down on Greece pessimism. It's day to day. But we don't have that much exposure to Greece. At least the U.S. economy does, right?
No, and even Europe doesn't have that much exposure to Greece. I mean, Greece's economy is probably about the size of, you know, Detroit. And the European Union is about the size of the U.S. So relatively, I mean, Greece, economic-wise, is a very small player. And they've been in essentially a depression for the past couple
I
years.
was there. Unemployment is anywhere between 20 and 40%, depending on how you crunch the numbers.
Yeah, I've been there for years. Housing prices are down 40% over the past couple of years. Most of it, 4 or 5% of the population has left Greece. I mean, these are problems that even if they come into a deal or if they don't come into a deal, either way it plays, these are long-term problems that aren't going to get solved overnight.
Okay, so let's talk about the worst-case scenario for a moment. Greece doesn't come up with a deal. We get to next week. They're in technical default. What do you think happens next to the markets and to the European markets?
Well, I guess the first point to make is that Greece has been, since it's been independent for over 200 years, half the time they've been in default or restructuring their debt or something along those lines. So this isn't new for the markets per se. So let's just say that happens. We get the default. They don't get their payments. I mean, within Greece, you know, that probably leads to capital controls as people are worried about getting their money out of the banks, and that's a big problem within Greece. For the markets at large, I think it comes down to a question of, you know, what lessons do people learn from Greece, right? So if it kind of works out well for Greece, maybe you get more people in Spain looking to leave the European Union, or Portugal, or kind of the knock-on.
Yeah, they're worried about a domino effect.
Right, but you could almost see it happen the other way, I think. You might have a case where Greece leaves, and it goes really south for Greece quickly, and people say, we don't want that either. We're going to do every effort we can to stay in the euro and stay within the European Union. So it could really kind of go either way. Handicapping, that's hard. I think that's why you kind of have to be balanced and diversified. But I think any type of pullback you get on that probably spells more opportunity.
You mentioned diversification. Is there a way investors can play the Greece default to their benefits? Or do you caution to stay away from the whole issue?
No, I mean, we think there's opportunities within Europe. I mean, there's great worldwide companies in Europe. They're going to be in Germany or in the UK or France. And I think you can play those. And if they do get, you know, a bit of a sell-off on the Greece news, the Greece event, you know, that may be a case where you, you know, kind of want to buy on that dip, I think, might play out that way.
Final question on interest rates. We got some news that the Fed might be looking for in raising rates, which is that the employment market appears on paper to improve, and that wages actually had a pretty good comeback in May. Are those numbers that are going to lead the Fed to an interest rate hike maybe by the third quarter? Yeah,
you know, we still think September is the most likely. The consumer looks to be in great shape. The U.S. economy looks to be doing well. Consumer spending increased in May, which was something we were looking for, as wages increased, and we know prices at the pump are down. So we were looking for that consumer to come back, and we're seeing that. So we think that does lead to the Fed increasing interest rates. But again, maybe they do it in September and then are on hold and do it in December.
Well, they talked about the path and not the dates, right? And is the path important to watch?
Right. And I mean, if we go from 0 to 0.25 or 0.5, does that derail things? I don't think so.
And consumer sentiment continues to tick up. Why do you think Americans are feeling more optimistic?
I think part of it just kind of coming to grips with the economy kind of being in this slow growth but not no growth mode, and they've kind of accepted that.
Like accepting the new normal?
Yeah, essentially. But I mean, wages are improving. They got kind of that tax cut at the pump. As prices fell, they've now got more money in their pocket. The employment situation is improving, kind of tight job markets. Housing starting to come back. We saw existing home sales jump 5% in May. So there's a lot of things in favor of the consumer, and we think that what bodes well for the consumer bodes well for the U.S. economy.
Okay, Jeff Demaso, Director of Research Advisors Investments. Have a good weekend.
Thanks, Andrew.